Sunday, the 17th of May 2020. I haven't done a gold chart and macro update for the last 5 or 6 weeks. I've been focusing mainly on the sort of company announcements and the quarterly reports of a lot of the ASX gold stocks. If you're new to this channel, have a check out of the Patreon channel as well. This is a free video on YouTube, but I put up a lot more content on Patreon. There's a link in the comments to this video, so come and have a look there if you're interested in some more gold stock content. The gold chart itself looks tremendous in the last few weeks. We've seen this nice sort of consolidation zone. I think I talked about in the last video that this 1680 level was important. It looked like it was the kind of a breakout level from a potential sort of inverse head and shoulders pattern that was forming, with the shoulders at around this 1570 level, and then the head at that sort of 1460, 1470 level there. And a breakout above that sort of implied a target, sort of a measured move target toward $1,900 an ounce. That's sort of this, this 250 sort of range here. If we can break out above that, or it's almost $300, actually more like 300, that another repeat of that move gets you toward 1900. So that's kind of what I thought was forming, and we've seen after that video was published on the 12th of May, I think. So 12th of April, sorry. It did consolidate. It did rocket up a little bit higher, but then has since consolidated. And I was a little bit cautious here because I thought we might be starting to roll over, but the market's still got that kind of upward bias, which is really nice to see. That even in a sort of consolidation or slight downtrend, that it's kind of generally having higher lows, and then we saw a nice move in the last couple of days where it broke out of this consolidation zone and moved up again to new highs for the move. So I think 8-year highs now, back up to levels not seen since, you can see it there, since 2013 or late 2012 even. So it's hard to imagine a better looking chart really. I think we probably more of a grind higher here in the short to medium term. It's still not, even though it did consolidate for sort of 5 or 6 weeks, it had a strong move till then. I think you're unlikely to see another sharp move of sort of $200 or $300 right now. But I think this grinding moves, you can see all these uptrends within this larger uptrend, all the consolidations, perhaps apart from this move late 2019, have been sort of quite kind of sideways consolidations. I think obviously a lot's changed in the world since late 2019 as well. This coronavirus has really taken markets to a new phase, taken Fed action and all of that to a new phase as well, which I've talked about quite a lot, and I'll mention a bit when I go through the S&P 500 chart. But it looks pretty positive. I think again the sort of analogs to that end of the in the GFC when the gold price spiked down. I talked about that last time. It looks like we've had that move, and you can see here that's what we really had. They had these grinds sort of even within the kind of consolidation periods. The market was not necessarily moving down or sideways. It was kind of an upward sideways movement, I guess. So that's kind of what I'm hoping for again. Like I said, I think we might grind a little bit in the shorter term, just because we're not completely, the market wasn't completely oversold, and it's still, it's it's still probably a more bullish stance than neutral. So I think it probably can only grind a little bit at the moment, and I expect to move. If you look at a bit of a break out of this consolidation triangle, you'd probably be looking at something toward that sort of 1760, 1770 sort of level in the short term as kind of a measured move out of this little breakout. But again, we're seeing the nice sort of sideways step motion consolidations, work off some of the, take a bit of a breather in the market, work off some of the speculators and let them go and play elsewhere if they're not interested anymore. But I think, this is very positive price action. So I'm pretty happy about how it's playing out, and how it's starting to play out into some of the other gold miners as well, which I'll talk about. The Australian dollar gold price looking very positive. had fallen away, sort of broke down below this sort of upward trend line. I didn't think it was going to be able to hold that sort of pace for a longer period, because it just, moving up at kind of $100 a month basically for the last 4 or 5 months. It's not sustainable, that sort of pace, but and the currency had to started to outperform, and I'll go through that in a second as well. But still almost at record highs in the Australian dollar gold price, and that's very good for the mining companies, which if you go through a lot of the quarterly reports, the analysis of quarterly reports I've done in the last sort of 4 or 5 weeks, it's playing into the gold prices that they're receiving. Even if they've got a bit of hedging, they're still getting mostly spot prices, which are at these record levels. The dollar index is probably another one I can mention. I'm even though I'm quite bearish on the Australian dollar, that doesn't necessarily mean I think the US dollar is going to soar here. I think the Australian dollar is kind of likely to be one of the weakest currency performers in the market environment that it's coming in the next 12 months or more. In this sort of recessionary conditions, I can't see Australian dollar being a good performer, but that doesn't mean I think the US dollar is going to soar high here. I've read a few things about this sort of predictions of US dollar shortages, and that's going to massively push up demand for US dollars because of US dollar denominated debt outside of the US. I'm not a believer in a lot of that. I think the Fed is just we're into a new paradigm here where the Fed is just going to print whatever is needed. I think negative interest rates are a real possibility. I don't see negative interest rates probably unlikely to be positive for the US dollar. So I think we've been in a US dollar bull market for the last 5 or 6 years. I think people who sort of talk about that theory probably neglect that fact that this has been since 2014, when we had the surge in the US dollar against all currencies, particularly against the euro and also the Australian dollar. We've been in a bull market, so I don't reckon this is going to just break out of this toward like this move we had in the dot-com bubble kind of thing. I think it's a completely different environment that was driven by, even though there was a lot of speculation then, it was also driven by real economic growth. That's not the environment we have now. And I'm still I think the US dollar is more likely to roll over, but Australian dollars I still think going to be the weakest currency, or one of the weakest currencies you can think of. And if you remember the last video I did in April, I sort of talked about how we were kind of in the eye of the storm in terms of Australian economic data, and I expected it to roll over. And we saw the unemployment figures come out this week in Australia that were at the headline number was only 1 or 2% higher, which is a joke, because it's really just been a lot of the real weakness is being masked by these stimulus payments and JobKeeper and this sort of thing. So that's really meaningless now. But if you looked beneath that headline number, it was an extremely weak report. It was weaker than expected, and I think we're starting to roll over now. I've been buying some US dollars here just as a cash proxy, as opposed to keeping Australian dollars. I've been buying a bit of US dollar ETF, and I think we're going to roll over here as that economic data starts to get worse in Australia in the next few weeks, as we start to get into the real sort of heavy period of the coronavirus lockdown. And I think they're talking about that maybe 40% of people were unemployed in April. Just some tremendous statistics. I think almost 6 million people are on that JobKeeper allowance. It's already sort of getting toward the upper end of expectations. So there's all this talk about because of the health effects have kind of got better in terms of the Australian handling of the health sort of crisis has generally been fairly well received, and I think that optimism is coming back, and there's stuff's reopening, and there's a little bit of optimism, but it's masking the reality of all the problems that existed before this. And I've talked extensively about this probably the last 3 years, that I thought that those debt issues in particular, and this is really going to show all of those once these loan repayment holidays from the banks roll over, and a lot of these jobs that were lost never come back. what's going to happen then? You can only defer people's loans for so long, business loans as well, before the banks actually have to start, you know, doing what banks do and seizing assets and letting people go bust. So that goodwill that's sort of between the government and the banking sector and all of this will only last so long. And I think in probably the next 3 to 6 months is when it starts to roll over. And I'll talk about the CBA in a second, actually. The ASX 200 chart has sort of stalled at this lower upward trend line that I've had for quite some time. I think again probably looking similar to the Australian dollar in the way it's rolling over here. I'm not bullish on the ASX at all in general. I mean, it has rallied. If you took it from the lows, it's rallied pretty well. It's up sort of a bit more than not quite 25% there from the absolute lows. But if you sort of took out that 2 or 3 day period there, it's really been a fairly anemic rally of maybe 10 to 12% from that, say, 4,800 level. So it looks like it's sort of running out of steam here. I was looking at the CBA chart, Commonwealth Bank. Last week they came out and they deferred their dividend. Westpac has suspended their dividend that they were due to pay, and I think NAB has cut theirs, but also did a capital raising at the same time, which is always a bit stupid. And you see companies they're raising money and then sort of robbing Peter to pay Paul kind of thing. But this CBA chart, I think I generally look at this as more of the biggest bellwether sort of in the ASX, the biggest of the banks, and it's a very weak sort of formation that's coming here. It's not bouncing at all. We've seen that low interest rates and a low interest rate environment is generally extremely negative for banks around the world. I don't see how it's going to be good in Australia. We're flirting with this downtrend line here. It's struggling to bounce above it. I think we could be forming a sort of a bit of it'll be consolidate here for a while, probably given the extent of the fall, but I think we're going to roll over again, as I said, when we start to see how those unemployment statistics feed into ability to pay loans, and all this sort of stuff that's been the real weakness in the Australian economy for the last 5 or 6 years. And a lot of the economists never really saw it as an issue to start with, so they still don't see it as an issue now, and they still think things are going to return to normal after this is done. And I don't see how that's going to be possible with the scale of unemployment that we have. We're seeing levels of unemployment not for at least 30 years, and possibly since the Great Depression. This is unprecedented, so I don't see how the market's going to bounce back. And also, I don't think the Fed, the central bank in Australia, the Reserve Bank, has the same sort of ability to stimulate the share market as it does in America, and the same sort of Pavlovian response to always do that when the share market goes down. In Australia, it's a bit different to how the market works in America in that sense. The S&P 500 has bounced extremely well in the last. It's probably more like 20 to 30% up from that low period, and a lot of that's been driven by this Fed money printing that we've seen. Up to almost 7 trillion in total assets for the Fed. We were up sort of almost $3 trillion in the last 3 months. This is just unprecedented levels of asset purchases, and it doesn't look like it's going to be enough. And they just started doing the buyback of corporate bonds this week that I mentioned in the previous video. I think they did 300 billion this week alone in corporate bond buying. So we're into a new paradigm here in terms of the Fed's intervention in markets, and whether that can save the general economy, I don't see how that's going to be possible. It might save the stock market, but eventually at some point the stock market will reflect the underlying economy. A lot of this is being driven by the tech stocks, and I saw some stats recently. I've seen a couple of charts on this. This was a chart showing the Robinhood's retail investor app aimed at a lot of younger investors, and the number of people joining Robinhood has massively spiked in the last 3 months, and also just general trading accounts in America, this was some of the largest online brokers. Huge increases in new share trading accounts from young people predominantly. And I mean, this was only in March. I think you'd see even more. The numbers would be even more stark in the second quarter. I think March would made up 2/3 of these numbers. But huge increases in new entrants into the market. This is not what you see at a market bottom, and it reminds me of this the very sort of classic bubble chart and these emotions here, and this US S&P 500 chart. Just this is a classic bull trap when you see young investors who have had no market experience jumping in at the end of a 10-year bull market, the longest bull market in US history, and buying the dip here, thinking that this is exactly what it says here, return to normal. Normal being the uh, overvaluation and market hype of the last 3 years. To see this and this increase in broker accounts buying the dip, this is like classic stuff that you see at a sort of bull trap in a market. So that when I saw those stats, I was quite astounded because I think partly some of this is probably to do with there's a lot of people at home looking for something to do. Other forms of gambling aren't available. People say this in jest, but I think there's probably something to that. And they're looking at the market. They're looking at tech stocks predominantly as the thing that's going to be the driver. But again, these tech stocks, they make their money in the real economy. At some point, if the real economy rolls over, they're not going to be making. People aren't going to have the money to buy iPhones or to even have Netflix accounts if things stay as bad as they are for a long time. And it seems like this is, as I kept saying, I think there's going to be a protracted downturn. So yeah, I thought those stats were very interesting in the context of sort of where we are in the cycle here, and I'd be very cautious in the US market at the moment. And I've seen there were some comments from Stan Druckenmiller this week as well, saying that the risk rewards the worst he's ever seen in the US share market, and he's one of the most sort of successful investors, particularly sort of macro style investors of the last sort of 30 or 40 years. So I tend to pay a fair bit of attention to what he has to say. So again, it looks pretty bubbly there. Final couple of charts. I'll look at some of the gold stock indices. I mentioned these a few times in the last video. The GDX chart was looking very good. Looked like it wanted to get toward the previous highs since 2016, which are around that sort of 31, 32. That was when it was around here, and it's went up through that level, sliced straight through it, gapped up, and we've seen Newmont and Barrick and all these bigger companies doing very well, and that again looks like an extremely strong chart with the nice sort of slingshot move with the clear out, and the partly that was to do with sort of index effects and the way the sell down in the ETF and liquidity problems of the underlying instruments. But as I've mentioned in a video on the Patreon channel, I did quite a lengthy one on the ETFs. But this is a very nice looking chart. Looks like there's plenty of upside here. Still, I think there's not a lot of clear resistance levels. Potentially, you can see this move up toward that sort of 40 level there, which is the only sort of obvious resistance level in the near term. But I still think there's so much room for upside in these gold stocks compared to the bear market we've had has been so long. There's very little interest here. We're starting to see a little bit of mainstream interest. I commented in the last video, or maybe the one before that, I thought that gold was going mainstream, and we're kind of in that fourth innings of a gold stock bull market. In baseball terms, a 9-inning game. So this is starting to catch mainstream attention, and it's generally been flowing to the major gold stocks first, so the constituents in the GDX. The GDXJ chart has been lagging still. You can see I've got that same red line to show that 2013 to 2016 sort of levels. It's still below its high in 2016, but it has broken out of this sort of little consolidation, not quite above the intraday high there, but the Friday move looked very positive in Australia and in the overnight US market action on Friday night. A lot of gold stocks doing extremely well, a lot of 5 and 10% moves. So you think, it looks like it wants to go and test that 2016 high around 52, but again, the GDXJ is even more sold off. Uh, Granted, a lot of the companies in this index have been, real turkeys over the last sort of 5 to 10 years, and that sort of shows why there's been little interest in the junior gold space. But I think in this environment where gold is just doing so well, it's hard to see that these juniors don't catch a massive bid, and you start to move as real leverage plays, developers, producers, developers, and sort of high cost producers and companies in construction as well. I've talked a lot about West African resources. I mean, that's not even in the GDXJ. The GDXJ is still, they call them juniors, but a lot of the companies are not juniors at all. I mean, Northern Star is in the GDXJ still, and that's a 1 million ounce producer. But so I think the tier below the GDXJ, and there's not really an index to watch those stocks, but that's going to be where I think the real action probably comes, as well as the money starts to filter down. And so I think this GDXJ chart looks very good, but it's not necessarily representative of the whole junior gold mining space. But if you can look for the very successful companies will outperform this index, because it does include a lot of the bad ones too. So that's what I try and do on the channel, is really look for the opportunities in stocks that are going to outperform their indices. If I believed in investing in the indices, I probably wouldn't run a channel where I analyze individual gold stocks. So that's probably all the charts I wanted to go through. My standard set of charts, but it's hard to think of a more bullish scenario from a macro and charting perspective for gold and gold stocks at the moment. I mean, I like to keep on my toes and sort of not get ahead of myself at how things are evolving. I get a little bit defensive, and that's why I don't like to hold companies in sort of weak sort of operational states as well, which is another thing I talk about a lot on the Patreon channel. But I think so. It's trying to be defensive here, but looking at the macro environment, you have to think this is still very positive conditions for gold. You're going to see those gold stocks continue to move up, is my feeling. I don't see an immediate top. I think some of the stocks on the ASX are starting to look a little bit elevated in the last few days, and maybe sort of signaling that a short-term top might be there in the next week or two. But with this gold price backdrop, I'm really trying to stay long the good companies and not trade the short-term tops, and just play this longer-term trend in gold, because I think we're still in for a rocky ride in terms of Fed intervention, and probably general share markets rolling over in the rest of this year, is my feeling. But so that's probably enough for now. And as I said, if you're interested in more content, have a look at the Patreon link in the comments below. Thanks very much.